So this morning, I'm delighted to be joined by Timmins, who's the joint CEO of Fintel. Fintel is an AIM-listed company. It's a UK fintech support services provider that offers award-winning technology, compliance, data solutions, empowering intermediate businesses, product providers, and millions of customers to make smarter financial decisions. Matt, welcome.
Thank you, and delighted to be here. Thanks for having us on this morning.
Right. Well, so you guys have been very busy. The business has performed particularly well this year. Do you want to talk us through some of the highlights?
Yeah, absolutely. It's been an incredible start to the year for Fintel. We have delivered a good set of financial results. So the core revenue is up 13%. Some subscription revenue up 6%, and EBITDA up 5% as well. So good set of numbers, good set of results. I think more than that, though, or on top of that, is the progress that we've made strategically. So in the last just over 12 months now, the business has made 8 acquisitions and 2 other investments into some really solid companies in our sector, some good fintech solution businesses and support service business as well. So we've made some real investments. So those acquisitions, we've extended the platform of the business by over 900 firms and 10,000 individual customers through the acquisition of 360. And we've also invested a lot of money into a product called Matrix 360, which we're delivering as part of the de facto solution. So I'd say that, as far as the first half of the year is concerned, good financial results, but the main thing to focus on is the strategic advancements. What we're building here now is the next sort of chapter in the evolution of the business. And we're investing heavily into fintech solutions because in the main, intermediaries use lots of different solutions to give advice to clients. And many of our customers are saying that it's wholly inefficient. They're not able to transfer data easily amongst the systems. The workflows and UI and UX is all different. So we've set about the challenge of helping intermediaries to do a better job for their clients and make it more efficient for them. So, as I say, a lot of investment into the business and set ourselves in the right position for the future.
Interesting. You mentioned the strategic progress. I mean, what's been the main focus so far this year then?
Yeah, I think we can break that down into perhaps 3 categories. So one category is investing into fintech businesses. So we're building a connected platform of solutions for intermediaries to use with their clients. And on average, intermediaries use 9 different pieces of software just to do a job for their clients. And as I said, the situation for most of them is very inefficient. And we have gone and acquired the best businesses in the market. And we're integrating those businesses together through 2-way API integrations to ensure the seamless flow of data between them, and also that workflow and UX and UI is common amongst those operating models. So that's been the first sort of real big investment. Now, those businesses have got their own clients and they will grow at their own pace as they did before we acquired them. What we believe we can add on top of that is the ability to essentially get the connected platform in the hands of really large intermediary businesses, ones that it will, massively benefit and help them manage risk and complexity within their business. So you get the advantage there of having the revenue and EBITDA generated by the individual businesses as a sort of core part of the acquisition, and then we're hoping to layer on additional revenue and EBITDA on top of that. So that's the first point. Is the investment into those technology businesses. The second important advancement has been the extension of the customer platform. So we added 360 with 900 client firms and over 10,000 advisors to the business earlier on this year. And that's a massive advancement for us. That's almost the doubling of the number of intermediaries that we serve within one deal. And we've been tracking that business for over 15 years. I mean, they've got a real quality management team, a great business, some wonderful clients, and the opportunity presented itself, say earlier on this year or more latterly later last year. And we've been going through the process to acquire them and finally got the deal over the line. So we're absolutely delighted with that. So you add in technology into the business and then an enhancement of the customer base, and that sets us fair for the future. In addition to that, and the sort of third leg of the stool, if you like, is the internal investment that we've made into a product called Matrix 360. We have an existing product in the market called Matrix. It's used by general insurance providers, banks, and also asset managers to help them understand how their product compares to other products in the market. So it's a product database, if you will, or a database of product features. And it contains one set of data, which is product data. And that data has been used for over a decade by the largest insurers in the land. And what we've done is we've invested into that product to bring in 7 more data sets to it. So we'll be bringing in pricing, we'll be bringing in weather data, economic data, and a whole bunch of other data sources that they currently use to make decisions, but they buy that data in from other vendors. And we're hoping with Matrix 360, what we will have is one solution for the GI market predominantly to use when assessing and comparing product and pricing information, along with what's the likelihood that they will sell X volume of products in the year. What moves that dial in particular? Is it if we have a hot summer, do we sell more car insurance or more travel insurance, etc.? So there's lots of different data points coming into Matrix 360. We've launched the first version of that, and we're out in the market now selling that product as an upgraded product to existing customers. And over time, we'll build on that and we'll build in the other 6 data sets into it. And that product will become much more valuable to insurers, and therefore that will get reflected in the price.
Well, you've clearly been on a sort of M&A spree, so to speak. Can you talk us through what's the thinking behind this process?
Yeah, so I think, as with most decisions that business like ours faces, when you want to enter a new market or you want to sell a new product or find a new customer base, there are a number of choices you've got. You can organically work on that and recruit people in and build from the ground up. You can develop a partnership or joint venture, or you can go out and acquire the talent or the product set that you want to acquire. And so we've done a combination of those things. We invested the year before in a great partnership with Tatton Asset Management, and that's paid dividends for both businesses. We've invested organically into the growth of Matrix 360, recruiting in the talent and building the database architecture from scratch in-house. And then the other thing that we've got at our disposal is a great cash conversion in our business. So we generate a lot of cash and we want to use that cash to stimulate further growth. So we've got an RCF facility with 3 banks, up to 80 million, along with a cash generation. And we think now has been the ideal opportunity to put that cash and that RCF to work and go out and acquire the businesses and talents that we want. So it's been a combination really of all 3 strategies.
We're talking more about those 3 strategies you're talking about there. Obviously, the business is evolving here, but is this, can investors expect more of the same, or what are you looking at, sort of looking ahead?
Yeah, I mean, we've demonstrated our ability to acquire great businesses and bring them into the fold. The next thing I think investors want to see from us is our ability to pay down the debt very quickly, which we demonstrated when we acquired Defacto in 2019. So it's a repeat of that. We want to pay down the debt at a rapid pace. And then also demonstrate to investors that we've made the right decision in the businesses we've acquired by integrating them quickly and showing the fruits of our labor through enterprise sales. So I think over the next period of time, you can expect us to concentrate on the investments that we've made rather than go out and have another prolific M&A run. That's not to say we won't acquire something if the opportunity presents itself. We've always been very selective in terms of the businesses we bought, and I guess we're even more selective today than we were 12 months ago. So still an opportunity to add to the business, but that's not the sort of core part of the strategy as we roll forward. As I said, when we think about the business, when Neil and I and our CFO David sit down and we plan for the future, we're thinking in 5 years' time. We're thinking, what's the market going to be like in 5 years? What products do we need? What strategy is going to get us there? So we're very much investing for the future. I think we've made a lot of those investments in the acquisitions that we've recently made, and the job now is to get those acquisitions working properly for the group.
So I was reading there actually, and interesting you're saying that about the core part of the business. I think, correct me if I'm wrong, but I think it's about 65% of the SaaS and subscription revenues is your core business now. So, from my perspective, I'm going to look at this and how do you expect to drive continued improvement into that earnings quality?
Yeah, it's a key metric for us. So as one example, the acquisitions that we've made in the main are software and subscription businesses. Most of them are software businesses. So when those acquisitions gather pace in the future, you'll find that a larger percentage comes from SaaS and subscriptions as a result. You've also got the investment we've made into Matrix 360, which is a subscription-based product. So the more we grow the revenues there, the more that will add to the overall SaaS and subscriptions and also the percentage. So I think it's continually investing in our own core SaaS and subs products, acquiring new SaaS and subs revenues, and then looking at those revenues in the business that aren't SaaS and subscriptions and seeing whether there's an opportunity to convert those revenues. An example of that would be the relationships that we hold with product manufacturers. For 15 years, we have contracted with product manufacturers on an annualized basis, and therefore it's been repeating income rather than recurring income. And 2 or 3 years ago, we converted that over to distribution as a service product with 3-year recurring income model, and that's moved the dial again on SaaS and subscriptions. So you can look at existing products and see where you can convert those to a higher quality revenue stream as well.
That's great stuff. Well, retail financial services is something that I know particularly well. I haven't been involved in it for many years, but it is very much a changing market, particularly with the regulations and everything else. How does this fit into the play with your growth strategy?
Yeah, well, first of all, I mean, I think it's a great sector. I genuinely believe that consumers get massive choice in this market, and the products and solutions that are offered by well-capitalized manufacturers at a price and value that's commensurate with the competitive nature of the market. So I think it's a real solid market for consumers. As you know, for everyone else operating in it, it's quite tough. It's heavily regulated and highly fragmented. And I think both of those features of the market play into our business model. So as regulation gets tougher, more and more firms want to outsource compliance and business support to people like Simply Biz, Compliance First, 360, our core brands in that market. I also believe that there is a demand now coming from the intermediary sector for integrated technology solutions. These businesses want to get more efficient as they grow and scale and try and serve more and more customers. We know there's lots of customers out there who aren't served by financial intermediaries that want advice. And I think the best way for advisors to do that is to become as efficient as they can do in their own operations to allow them to serve more clients. So I think that plays into our hands. It's another tailwind for the business. And then there's an increasing demand for data. This is a very much turning into a data-driven organization, a data-hungry market. And we've got data on 43,000 financial products, the largest database of products in the market, and data on buyer behavior and advisor preferencing through the de facto engage product that we've got. So the data that this business holds is unrivaled really in the market. Nowhere else can you find data on consumer behavior and products and intermediaries all in one. So I think those three things, the increase in regulation, the demand for integrated technology, and the demand for data are the real tailwinds behind the business model. So our job is to take those tailwinds and build on them, make sure we've got data that's accessible, that it's in the right kind of format, that helps product providers make decisions, that we've got a large intermediary base that we can support, do a good job for their clients, that we're helping them with regulation and providing seamless tech. And that's the strategy and the role of our business.
Well, Matt, it's been fascinating talking to you. Thank you very much for your time and best of luck with the last quarter of the year.
More than welcome, and thanks for Sandbox again. Much appreciated.
Great. Thank you.